Introduction: the moving average myth. Most traders use moving averages the wrong way, and unfortunately, it costs them their hard-earned money. If you are relying solely on moving average crossovers and chasing trends blindly, you are already behind in the trading game. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. These lagging lines are often misunderstood as magical crystal balls, but when traded without proper context, they will lead you straight into whipsaws and massive drawdowns. In this video, you will learn how to use moving averages the smart money way. We will show you how to combine them with precision, structure, and multi-timeframe confirmation so you can stop guessing and start entering the market with absolute confidence. Before we dive into the charts, let's break down exactly what you will master in this lesson. First, you will learn how to spot real market trends. Second, we will teach you the smart way to catch reversals before they happen. Third, you will master how to use moving averages as dynamic support and resistance. Fourth, we will show you how to combine price action and structure for high-precision entries. This complete trend-following system works across all financial markets. If you are ready to trade smarter, make sure to subscribe and let's get started. Part 1. The 3 chief purposes of moving averages. Moving averages are highly powerful tools, but only if you understand their structural purpose. They serve 3 main functions on your chart: identifying the market trend, spotting trend reversals, and highlighting dynamic areas of support and resistance. Let's break each one of these down step by step so you can apply them cleanly. Let's start with trend identification. The moving average is primarily a trend-following indicator. Its mathematical formula smooths out the chaotic daily price data, allowing you to easily see the overall direction of the market without being distracted by minor wicks and market noise. The simplest way to determine the trend is by comparing the current price to the moving average line itself. If the price is trading above the moving average and consistently remains there, we are in an uptrend, and you should only focus on buying opportunities. If the price is trading below the moving average and continues to stay under it, we are in a downtrend, and you should focus on short setups. However, in sideways or ranging markets, the price will continuously bounce above and below the moving average with zero consistency. These are choppy conditions where you must stay out of the market. Part 2. Dual moving averages and the angle rule. To significantly improve your trend analysis, we recommend using 2 moving averages with different time frames, a short-term average and a long-term average. In this strategy, we use the 2-0 period moving average, shown as the white line, to track the short-term trend, and the 2-0-0 period moving average, shown as the yellow line, to capture the overall macro direction of the market. When the price is trading above both the 20 and the 200 moving averages, the market is in a highly bullish phase. If the price is below both, it is highly bearish. But what if the price is below the 20 MA, but still trading above the 200 MA? This represents a short-term pullback within a long-term uptrend. In this scenario, selling is extremely risky because you would be trading against the macro institutional flow. You must stay patient and wait for the price to find support. Another secret of professional traders is analyzing the angle or slope of the moving average, which tells you the strength of the trend. In an uptrend, if the moving average curves upward at a steep slope close to a 45-degree angle, it signals strong bullish momentum. However, if the slope is very flat or gentle, it suggests a weak uptrend that is rapidly losing steam, indicating you should proceed with caution. In a downtrend, the exact same logic applies. A sharp, steep downward slope indicates powerful bearish pressure, which means you can look for aggressive sell setups. A mild, gentle downward slope shows that the sellers are losing control, and a potential reversal might be around the corner. The slope is your visual cue to adjust your trading aggressiveness. Part 3. The 50/200 reversal crossover. Now let's discuss how we use moving averages to spot trend reversals. To do this, we monitor the 5-0 period moving average and the 2-0 period moving average. When the shorter period 50 MA crosses below the longer period 200 MA, it generates a bearish crossover, signaling a massive shift in market structure from bullish to bearish. These crossovers are widely used to detect major shifts in macro market direction. However, we do not recommend blindly trading every single crossover. Instead, we use the crossover simply as a macro filter, and then combine it with price action structure on the lower timeframes to find our exact entries. This is how you align indicator logic with raw price action. Part 4. USD Buy Setup Confluence Masterclass. Let's look at how we execute this with high precision using our first case study on the XAU $15 minute chart. To find a high probability trade, we look for confluence, which means multiple independent signals lining up at the exact same price level. In this setup, we combine market structure, dynamic support, and a specific candlestick pattern. First, we identify that the market broke above a major resistance level, establishing a new bullish structure. After the breakout, the price starts to pull back. We mark the broken resistance level, which should now act as our new horizontal support. As the price pulls back to this horizontal support, we notice that the 50 period simple moving average SMA is curving upward and aligns perfectly with this exact support level. This creates a powerful confluence zone where horizontal structure meets dynamic moving average support. At this exact zone, we wait for price action. We get a doji-tailed bar, a candlestick with a very long lower wick and a tiny body. This wick shows a massive rejection of lower prices, proving that buyers have entered the zone. Before we buy, we must switch to the 1 hour chart to confirm our higher time frame bias. Switching to the H1 chart, we see that the market is in a clear, strong uptrend. Price broke out of a major resistance and completed a healthy pullback, rejecting the exact same level. This higher time frame context confirms our bullish bias. We switch back to the 1 5-minute chart to execute. We buy at the close of the doji-tailed bar, place our stop loss below the wick and the 50 SMA, and target the next key resistance. The price shoots up cleanly, hitting our target with zero drawdown. Part 5. The XAUUSD Sell Setup Confluence Masterclass. Let's look at a bearish example on the XAU 1 hour chart. First, we establish our market context. The market is in a clear downtrend, making lower highs and lower lows. We see the price breaks below a major support level. Once support is broken, it flips to become our new resistance level. We wait for the price to pull back and retest this broken support. As the price pulls back to the newly flipped resistance, we see that the 50 period simple moving average is curving downward and aligns perfectly with our horizontal resistance line. Once again, we have a major confluence area. At this exact zone, a bearish pin bar forms, leaving a very long upper wick that rejects both the resistance line and the 50 SMA. This wick proves that institutional sell orders have entered the market. To confirm our trade, we switch to the daily chart for our higher time frame bias. On the daily chart, we see a massive downtrend. The price has completed a pullback and has been strongly rejected from a key daily resistance level, creating a liquidity sweep. This confirms our bearish bias. We switch back to the 1 hour chart to execute. We sell on the close of the pin bar, place our stop loss above the swing high, and target the next support. The market drops aggressively, hitting our target perfectly. Conclusion and risk management warning. Combining structure, moving averages, and higher time frame confirmation is how you trade like the smart money. But remember this, no strategy, no matter how reliable, is a holy grail. You must always use strict risk management. One losing trade should never wipe out your account. If you found value in this video, please like, subscribe, and turn on notifications. Keep practicing, protect your capital, and I will see you in the next lesson. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.